You're looking for a tax-free retirement? Well, you are on the right page right now. I'm going to break down one specific way you could actually have tax-free retirement through life insurance. Something a lot of people are not familiar with, or they may not know specifically how it's done. So we're going to break that down. Ladies and gents, just here to drop a few cents. You're here with Earl, the money coach, a decade licensed in the financial and insurance industry, 2 decades in an investment portfolio experience. I want to break this down, but before we get started, make sure you like, follow, subscribe, and check the links in the description below where you could get automatically approved for life insurance, health savings accounts, and for my business owners, 6 figures to get approved to help jumpstart your business. But let's get right to it. How do you use life insurance as a tax-free retirement vehicle? Now, understand before we even get started, you need to know this. There's 5 life insurances, not just 2. Everyone says, oh, term insurance, permanent insurance. No, that's not it. There's 5. You have term insurance, whole life insurance, universal life insurance, variable universal life insurance, and index universal life insurance. 5 different life insurances. 4 of those 5 do have cash value, and that cash value can accumulate, and that accumulation gets to be tax free. That's super huge when you're actually having life insurances, but you need to make sure that they're properly structured. A lot of times I run into fellow insurance agents who do not have these plans structured, so you can't really count on it for being a retirement option. That's number one. Number two, please understand life insurance is not an investment. It's a supercharged saving strategy. Why? Because life insurance is not in the market, it's a reflection of the market. That's why within your life insurances, you can participate in the market growth, but you do not have to worry about any downside, any loss in the market. Right now is April 2025. We have a lot of stuff with President Trump talking about tariffs. We've seen pretty much the worst week in the start of April that we've had since 2020 COVID. So a lot of fluctuation, a lot of volatility. People lost a lot of money. But in index accounts and insurance accounts, you have that floor. So 0 is your hero. Now, why is this important? Because you want to use these kind of insurances as a supplemental income for your retirement. What supplemental income? It means you take a portion of something to supplement your regular income. So a little bit of Social Security, a little bit of 401k, a little bit of IRAs, a little bit of your stocks, all these strategies, you're putting them all together and they're all paying out supplemental income to help you sustain your retirement. The problem is most of you don't have it. The average person just has a Social Security. And got my computer here so I can have the updated statistics. The average Social Security benefit right now in 2025 is $1,907 a month. $1,907 a month. You can't get nothing with that. We all know that. We're talking 2,000 a month, 24,000 a year. That's not enough to be able to survive during retirement. But currently, with a properly structured life insurance, especially your IULs, your Index Universal Life, I've seen customers who've had them for 25, 30 years, and they're able to withdraw from 60,000 up to 130, 140,000 a year tax free. That is huge. So you're not just accumulating money, that money's been accumulating tax free, and you're able to loan yourself out that money tax free, which is huge. Now, what makes that happen? There's a few things. First off, you have to understand their codes. IRC, Internal Revenue Code. I tell people all the time, you have to understand the IRS's Internal Revenue Code is over 6,700 pages. 6,700 pages. Here's the kicker. Less than 200 of those 6,700 pages is how you pay taxes. That means 6,500 plus pages are specifically there to help you eliminate, deduct, lower, or avoid, or ultimately wipe out taxes as a whole. I say if you're reading books, that should be the first book you read, the Internal Revenue Code. But there's certain things in Internal Revenue Code that helps you with life insurance that allows it to be able to grow. First off, you have your 72E, your internal revenue code 72E allows that money to be able to grow tax deferred, meaning you're not worrying about taxes. All the growth within your life insurance ends up being tax deferred. Then you have 101A, internal revenue code 101A, which is pretty much allows your money to be able to grow income tax free. And then you have the internal revenue code 7702, which is pretty much what you use to have a properly structured policy that allows you to be able to have that money actually become tax advantage so you can get that withdrawal. So you have certain kind of tax codes and implications that help you. Now, obviously, the money grows tax free. Obviously, you could withdraw yourself with a loan, not a withdrawal, it's a loan. You could actually take a loan out and loan against your own money, and that could be tax free. There is a cost of insurance. Generally speaking, you take care of that cost of insurance up front. A poorly structured life insurance, it could take anywhere from 12 to 15 years to cover that cost of insurance. But a properly structured life insurance, especially your IULs, if you have it properly structured, you're funding it correctly, you're maxing it out, you could take care of that cost of insurance within the first 3 to 5 years. So a huge difference. You need to understand how to use that. But great thing I tell people, look at these predictions right now for 2025 growth predictions. Number one, all right, the annual caps and the annual rates that we've seen for a lot of these IULs and these life insurances are anywhere between 9 to 12%. Now, what does a cap mean? That means if the market does 20%, you may get capped out at 9%, 10%, 12%. Some companies do have more. I've seen companies have specific riders or specific parts that you could purchase into and kind of supercharge it and customize it to your liking, where they're averaging 14, 15%. My personal index universal life strategy last year, 2024, it credited me 24% of growth on my cash value. So you can have it differently, but generally speaking, between 9 to 12%, a lot of companies have a cap where you could actually use, which is huge because that's averaging more than a lot of your IRAs, your 401ks, and mutual funds. Think about it. You're averaging the same thing or more, but all of that's tax free without having to worry about taxation and penalties. You could have $1 million in an IRA before taxation and penalties. You could have $500,000, $600,000 in a 401k before you start withdrawing if you withdraw early penalties, or if you wait too long, they could actually tax you 50%. And that's called a required minimum distribution. If you wait too long in a 401k, which is 73 and a half, they're going to penalize you more. Taxation and penalties and fees take a lot of that stuff out. But the great thing is, not only is that the cap actually right now over the last 20 years, so we're talking 2000, 2001, the dot-com bust, the bubble, the 9/11, we're talking 2008, the market crash, we're talking 2020 when we've seen a huge drop. 2016, we saw some fluctuations. All that, the average IUL has been actually giving folks back anywhere from 7 to 9%. That's the average across the board. So some have more, some have less, but they've been averaging that range. That's a pretty good range when you have something that's tax free. But here's the thing. Here's the thing right now, excuse me. When you're talking about using that in actual literacy in 2025, they're saying that there's been a 21% increase year over year, people looking to get and purchase different kind of insurances for that tax advantage, for that cash value accumulation. I'm not saying it should be the only thing in your portfolio, but it should be something that you have so you have guaranteed cash value, something that's guaranteed to grow, and you're not going to lose anything. You have that zero downside, especially in your IULs, Index Universal Life. But it's key to understand it needs to be properly structured. If you're not properly structuring your Index Universal Life or these cash value policies, you're essentially buying a very expensive term policy if it's not done correctly. Which is why when you start seeing when a lot of these accounts started, when IULs were first around, in the late 90s, early 2000s, a lot of people just had them very basically set up. They may not have properly funded it. So now, 25, 35 years later, they were expecting X amount of money. but they didn't get that, which is why you need to make sure it's properly structured so you can capitalize on those tax-free gains as part of your retirement strategy. So once again, Index Universal Life is not meant to be your sole retirement. If you have insurance agents talking about that's all you need, that's a lot of BS, because you need to have more than just insurance as part of your portfolio. It should be a supplemental income. It should be something that's a part of your financial portfolio to help you during your retirement to create that supplemental income. If you want to see how that works, if you want to have a consultation, feel free to reach out to me, our expert and expertise in that, making sure you understand how that could work. And if you definitely want to follow, like, and subscribe to the channel to get more insight and information, you're here with Earl, the Money Coach, and we'll see you next time. Take care.